This talk is the only thing now between you and the drinks and nibbles, so I hope we can get through this fairly quickly. I'm going to talk to you a little bit about Serica Energy and what we've been up to in the last year or so. And there's a lot of parallels to James's talk. There's a lot of things that we believe that I think are pretty much the same. So we're looking to release value from assets that perhaps have been overlooked by people in the past. We're heavily focused on gas assets, and we also believe in not spending too much money up front and trying to get into deals that are innovative and give us the ability to add that value. We're a UK company based very much on the UK. We do have some assets overseas, which I'm not going to talk about particularly today. And our aims really are to add value to the projects that we have. To continue to build our portfolio, because we think there's the opportunity to build on the deals that we've just done within the last year, and to add reserves through exploration and production. So we're trying to base this on a production set of assets, but we do still have an ambition to explore, and we have some exploration going on as we speak at the moment. So we're really very, very focused on building the business organically and through acquisitions going forward. At the moment, our focus is historically has been on the central North Sea. In the central North Sea, we have non-operated production from a field called Erskine. We have a discovery, an exploration discovery that we had several years ago, a field called Columbus, which is being developed right now. We have an exploration well called Roallan. In the last year, and what I'm mainly going to talk about is that we've stepped out into the northern North Sea, where we bought production in 3 fields, Rum, Bruce and Keith, which we bought. The interest initially we bought from BP, and then subsequently we bought from the other partners that were involved in those fields, and I'll talk about those. And we'll talk about those deals in a little bit more detail. Initially we got into this to try and diversify a little bit from the only producing asset we had. We had production in Erskine, which has been very good for the company over the last few years, but it's a dangerous position to be to have single asset production. Something goes wrong with that asset and you're in deep trouble. So we were always looking to find something to add on to that. We ended up finding the Bruce, Keith and Rum assets, which, if I'm honest, were larger than we expected. Now, in contrast to James, who talked about everything in standard cubic feet in traditional gas units, we've converted everything in this presentation to talk in barrels of oil equivalent. So it's always confusing, but our reserves are mainly gas. We're probably 80% gas, 20% oil, but for ease of understanding, we've put everything in barrels of oil equivalent here. So the reserves that we bought from BP and the other companies were take our 2P reserves to 63.7 million barrels. So we have over 63 million barrels of reserves, and production from those assets last year of 24,000 barrels of oil equivalent per day. And I'll talk about what we hope to do with that. And clearly that gives us a huge immediate impact upon our cash flow. But significantly, we managed to do all of these deals with a deferred consideration. So we haven't had to pay upfront to buy 60 million barrels, which is quite a sleight of hand. And we haven't gone back to shareholders. So we haven't diluted our shareholders in order to make these acquisitions. So how have we done it? Well, we've agreed with the sellers, with BP, and then after that with Total and BHP, who we bought shares in those fields from. We've agreed to share the profits in those fields for the first 4 years. So in 2018, last year, the deal was effective from the 1st of January 2018, although it only completed at the end of 2018. In the first year, we share the profits such that those companies keep 60% of the net cash flow. This year it's 50%. In the next 2 years it's 40% and 40%. So we've bought this huge value asset We bought all these reserves, paying a very, very small amount up front. In actual fact, I'll come on to it, they paid us when we completed the deal. But we share the assets we share the profits with them going forward. Now, why would they do that? I mean, that is the question that everyone asks me. Are these guys stupid that they just give us their assets and only take a share of them going forward? They do it because they realise that companies such as ourselves can actually extract more value from these assets. We basically can focus on the assets. We can extend the life of the assets. We can basically get more oil and gas out of the ground than BP would have been able to. For BP, if you've got a great team of people, you're going to focus on perhaps some of their high capital projects that they have around the world or west of Shetlands. These older assets that take a lot more work, that take a lot more focus, take a little bit more TLC, are really not BP's sweet spot. They're not the sort of thing that Total does particularly well. They recognise that by allowing companies like ourselves to take over the operatorship, to run these assets, and even take the 60%, they are still going to make more out of these assets than they would if they kept them themselves. Significantly, if we can keep these assets running for longer, which we will do because we'll be a lower cost operator, so the economic life of the field will be extended. If we can keep them running for longer, we will push out the cost of decommissioning. And we're not getting away from the fact that there's 50,000 tons of steel here. This has to be decommissioned at some stage. BP, Total, BHP are keeping the responsibility for that decommissioning. We will actually do it, but we will push it out. It will happen much later than it would have happened under BP's stewardship. So we can help them make more from these assets whilst at the same time building a business for ourselves. So the impact of these deals is quite significant. To try and put it into perspective, I think I've already said we produced our share of production last year, so this was while it was still largely under BP's ownership, our share of production was around 24,000 barrels of oil equivalent per day. Now, this confuses a lot of people because people know oil price is $60 a barrel. People know gas prices in pence per therm or dollars per MMBU or whatever you're talking about. We've tried to simplify this. And for our assets last year, we received an average of $72 per barrel for the oil, average of 59 pence per therm for the gas, which that still doesn't mean a lot to people. On average, that was $45 per barrel of oil equivalent. So you can do some simple maths. You can say, right, 24,000 barrels of oil a day, $45 a barrel. Well, okay, let's go one step before we do that. What did it cost us for that $45 a barrel? What were our costs? Our costs were around $18 per barrel, which is, it's on the high side. I mean, I think around the North Sea, I'd like to get that to $15 a barrel, but this was when BP were running it last year, so I think we can get that down a little bit. But last year, the margin, if you like, was $27 a barrel, the difference between 45 and 18. So we made a profit of $27 on every barrel. If you say there's 24,000 barrels a day, that's somewhere in excess of $100 million a year that is being made as a free cash flow. Somewhere in excess of $200 million a year as a free cash flow from these assets. If you then, we accept we're going to share that 50-50 with BP or with BP and the other companies in the coming year. So that's still going to leave a free cash flow to Serica of well in excess of $100 million if we can perform in the same way that BP performed last year. So if we can realise $45 per barrel, if we can get costs of $18 per barrel, and if we can produce 24,000 barrels of oil equivalent per day. Now, we would expect that we will get this cost down. I mean, that's our huge focus now, is to keep our costs down, and clearly our focus will be to keep our production levels at least that. And we think there are good reasons that with more focus, with our new team that are working purely on this and are focused very much every day on these assets, we would think that we can increase the production rates year on year. This kind of just shows how we built up these assets. As I said, we bought the majority of the reserves from BP, but we actually did 3 other deals to buy out the other partners, Total, BHP, and Marubeni. And this is what it's done to our share price. And I'll digress a little bit here, and perhaps this is something that, again, I heard something from what James said here. If we look back to a previous deal that we did many years ago, when we bought the Erskine, our Erskine reserves, which were much smaller than the deal we've just done, it actually took the market a long time to wake up to what we were really doing there. And that may be what other companies go through at the moment. You can announce a deal that we thought, at this stage, we'd done the best deal in the world. It was the biggest thing we'd ever done. It was only after we'd been producing for 6 months and we were able to show the market some good, solid production figures that the market picked up, and our share price did kind of double overnight, but 6 months after we'd done a deal. So doing a deal is not when you always see the results. But the transactions we've done in the last 12 months have absolutely impacted our share price dramatically, and so we've gone from a market cap of back down here, well, back here when we were actually in the real micro cap, sort of 10-20 million pound market cap, to where we are today, up around 350 million. But we think we can add a lot more to that, because we believe that this valuation is based on historic data. It's based on what these assets were doing under the previous ownership, and we think we can add a lot of value. We can extract a lot more value from these assets. So what has it done to us? And I apologise for the colours on this. I looked at this earlier, and I think it might be difficult to see some of the colours. But basically, it's kind of catapulted Serica from a very lowly ranking in the UK to perhaps a mid-ranking in terms of our net production. I think what's more interesting is if we look at our gross production, so the amount of production that we're responsible for. This puts us now at the eighth largest UK operator in terms of the amount of oil and gas that we're producing on a daily basis. So we now have the team and the capability to compete with the largest of the UK independents. And that's very important, because we're not just stopping here. The idea of doing this deal was not to do this deal and then go back and light a cigar and count the money. The idea of doing this deal was this is the next stage towards getting further and further up this league table, if you like. But now we think we've got the operating capability to go out and find more deals, to solve more problems, and grow our portfolio accordingly. So how are we going to do that? I mean, I talked a little bit about the fact that we need to increase production if we can. Now, these are aging assets. I mean, the Bruce field has been in production for over 25 years, so it is quite a late life asset. The Rum field, which is actually where most of the value is for us, is actually quite much newer, and it is only halfway through its field life. But if you look at this, so this is the monthly production during the last year. You can see that, and I've quoted already, that on average during the year we produce 24,000 barrels a day. So on average it's through here somewhere. You have to kind of ignore the summer. You have a planned maintenance shutdown on most fields in the North Sea during the summer. But every other month, well, for the whole year we average 24,000 barrels a day. But you see that the variation between months is massive. So when we get everything right, we're for Bruce, Keith, and Rum, we can produce over 30,000 barrels a day. But some months we didn't. Some months it was down to barely 20,000. And for us, that's the task. Under BP stewardship, too many things were going wrong. There were too many trips. The process equipment would go down. They perhaps wouldn't have the equipment ready to solve a problem, get the field back up and running. And we have to focus on those things. And we have the engineers, and focus is the word that we come back to again and again and again. The whole of our company is focused on these assets, and our intention is to have more months that are like these 3 months at the end of the year. And we were the operator for this month, so this was the first full month. We took over during this month. This is our first full month. So we need to have more months like this than like that. And so our focus very much is on taking the 24,000 average that we had throughout the year and forcing it upwards. And I think that's the evidence that it is possible. We've got to deliver, and that's why I use the analogy, and we talked about the last deal we did, that it took 5 or 6 months of solid performance before we were able to tell the market what we were doing and see an uplift in share price. So, bearing in mind that we do have pressures on time, I'll talk about a few of the other things that we're doing and that are coming up. The Rum field, one of the 3 fields that we've bought, is a very prolific field. It produces a huge amount of gas, and I have gone back to talking in standard cubic feet per day. So the Rum field, where we have a 50% interest, produces 185 million standard cubic feet a day from 2 wells. So these are world-class wells. When this field was designed and first drilled by BP, it was designed, as you can see from the map here, actually with 3 wells. And the 3rd well was never put into production. They had some technical problems with the 3rd well, and so it's been producing for the last 8-10 years from 2 wells only. So our intention, and BP were planning to do this, but never quite got round to it. Our intention is to go back into that 3rd well. It's been drilled, it's connected up, it's ready to produce, but it has a downhole problem. Our intention is to go back into that well, and we're going to start some inspection work on it pretty soon in the 2nd quarter of this year. Our intention is to go back and reinstate that well to try and boost our production going forward. It doesn't make the field bigger. It won't give us more ultimate reserves, but in the short term, it will give us a boost to production. And we've got other things going on in the company. We are a full life cycle company, and we do have an intention to grow in all of these areas. So we want to explore, develop, and produce as we go forward. The Columbus development is a discovery we had. So this is a central North Sea, relatively small field. But last year we got government approval for the field development plan. And so, again, sort of similar to what James was talking about, these reserves will go from being a 2C basis to a 2P basis in our next report, because we now have a gas sales agreement and an FDP that was approved late last year. It's a single well which will be drilled next year, and that field will come on production in 2021. For us, it's good to have that activity and that development coming forward. We're also still explorers. So we have an exploration well drilling at the moment, the Roallam prospect, which sits in here in the central North Sea. This is one of the larger wells drilled in the North Sea in the last few years in terms of prospective resources. The net share to Serica is 20 million barrels of P50 prospective resources. So that's net to Serica. We have a 15% share. So this is a 130 million barrel prospect. The operator is ENI. It's a long well. It'll take 140 days. It got spudded right at the end of last year. It's pretty much on schedule. The objectives are largely Upper Jurassic sandstones at around 4,300 to 4,500 meters. It's high pressure, high temperature. We'll reach the reservoir, we expect, sometime around the beginning of April. It's on trend with the Culzean discovery, which is to the south. It's not that dissimilar it's at the same geological level as there was a big discovery announced a couple of weeks ago that CNOOC and Total had a discovery. We're at the same geological level than that. We're not claiming that changes our chance of success, but it shows that discoveries in this fairly crowded part of the North Sea, discoveries at this horizon can happen. We're also, we think, quite nicely positioned in that there are, if it comes in, there are 2 big lookalike prospects on the same block, and we've also just picked up the block to the south as well, such that if it is on the large side, we will actually have any extension of it going into our acreage. The key thing about it that I've not mentioned is we're not paying a penny for that well. It's a fully carried well. So through the years, we've done a significant amount of dealing to get to a situation where we've got a 15% carried interest in a 130 million barrel well. So really, that's what I was going to say. think I've done okay. I've got a minute left. So we've got a two-tier strategy at the moment. There's two things going on in the company. We've just taken over the responsibility for the Bruce, Keith and Rum fields. We now have that 24,000, hopefully more than 24,000 barrels a day of production. We need to deliver on that promise. You know, we need to be able to stand up here in 6 months' time and say, yeah, we've produced X thousand barrels a day. We need to do it safely. And we've got a great team in place to do that, and we need to build on that to extend the life of that field so that we can get even more ultimate recovery from that field. At the same time as doing that, and we do have the team to do this, at the same time we need to use our scale. We didn't have the scale a year ago. A year ago we had 7 employees. Today we've got 139. We need to use that scale to actually find more opportunities to do this trick again, to do another one of these deals or several more of these deals to grow the portfolio. We're getting now opportunities coming to us because we have that scale. So people call us and say, look, are you interested in what we've got? We need to build on that and we need to grow the company. In the presentation, there's a couple more slides which I'm not going to go through now, which gives you a little bit about the background and who's in the company, but I'm sure you don't want to look at those things right now. So I will leave you to it and take any questions.
Mitch, thank you very much. Hands up, gentleman here, straight away, thank you.
Good evening. First of all, I just want to say congratulations on the BKR deal and the fantastic shareholder value you've created over the last few years. Just a lot of your presentation was talking about increasing production rates, etc. But yesterday, Rockrose Energy produced a lovely statement, one of your sort of smaller competitors, increasing the amount of reserves that they thought they had, or could prove they had, and also extending field life. Mm-hmm. Could we look forward to a similar sort of announcement from you in terms of BKR?
Yeah, I mean, the whole intention with these assets is to extend field life and thereby extend the reserves that we have in place. Now, I'm not going to stand here and make any big claims that I'm going to add 20% or 30% or do this, and I do like, and you will have seen from that presentation, we'll always give historical numbers, which, you know, not everyone wants to hear that. But I'll tell you the story of Erskine, which is the last deal we did. We bought Erskine, which was a non-operated interest in BP, in Erskine from BP in 2014, 2015. When we bought that field, we were buying 3.2 million barrels of reserves, independently assessed by a competent person. We have produced over 2 million barrels from that 3.2. When we had a new CPR done at the end of last year, there are still 3 million barrels left. So we started with 3.2, took away 2, and there's still 3 left. The reason, and we've not drilled any more wells, we've not made the field any bigger. The reason for that is that we've helped to bring the costs down, to make the field, to make the operations more efficient, to get the uptime up so that we're producing more, so that it will produce for longer at an economic rate. You know, these fields don't just turn off. You don't get to the end of field life and it goes and stops producing. The end of field life is an economic field life. You get to the stage where it's costing you more to produce than you're making for it. So we've done it, or we were part of doing it with Erskine. We can't take all the credit for that. We were non-operator. We worked with the operator. The industry's got a lot better. Industry costs have come down dramatically in the last 5 years. So we know that we can do that. We knew we were part of doing it as a non-operator. Now, as an operator, we've got more control over what we're doing. So, yeah, we want to try and drive costs down, extend the life of the field, which will give us the opportunity to make the sort of announcement that you're talking about.
Just quickly, you talked about driving costs down. What are the main levers that you have to try and reduce costs?
I mean, one of the big levers is just not being BP. You know, our overheads are far lower than a major. You know, and but the most important thing about driving costs down and keeping uptime up is our focus and response time. So basically, BP, and you know, I don't want to sound like I'm slagging BP off here, because I am, but you know, they would say the same if they were here. They can't respond to things quickly enough, because especially in the post-Macondo world, you know, BP have so much process and procedure that to do something very, very simple takes a long time, and they don't have a joined-up organisation. So, you know, we have everyone that works on these assets co-located in one office. BP, for running these assets, have people in 4 different countries. So if you wanted to order a widget that you needed to fix a problem offshore, there were 4 countries involved in that. And you just could not move quickly enough, whereas as we can. We have to be nimble. We have to be able to do things immediately, and we're already seeing signs of things that we're turning around far more quickly than the majors possibly could do. So that's how we'll drive down costs. It's not by cutting costs, it's being more efficient and doing things more quickly. Time is money, I guess, is the way we look at it.
And there was where we're going, Pete?
Yeah, hi. I just wanted to build on that question because you part answered it. So what is the secret sauce to extend the longevity of the assets that BP ultimately you say might not be able to do?
Well, I mean, I think the other thing we've not talked about, and there wasn't really enough time in this presentation, but we will look at bigger picture ways of extending the life of the asset. The biggest single thing you can do with North Sea infrastructure is to get more hydrocarbons using your facilities. And so that involves looking for third-party fields that are coming across. So, you know, again, the same way James talked about, you know, he's not going to build a new pipeline to take gas back to Singapore. If someone finds a small field in the North Sea now, they're not going to build a new platform when there's a 50,000-ton platform like ours just along the road. So we would effectively rent out some of our spare capacity to third parties. We are open for business for that. We are encouraging that, and that is how that's one of the things we can do to make a step change in the life of the field. For various reasons, BP were not marketing this field in that way, and or this asset in that way. There were political reasons they couldn't do that, and you know, I mean, I'll explain that afterwards. We've not really got time to go through the whole history of these fields, but basically having a hub strategy, trying to get more oil and gas across the platform is the main thing we're trying to do.
Thank
Gentleman
you.
here, please.
Yeah, very interesting presentation. 3 quick points. The first one was you said you want to maximise the production from Rum and Bruce.
Yep.
As soon as possible. I don't understand the logic, but if you're paying 60% currently and you're down to 40% in 2021, what's the point of giving BP 60%?
Because what we need to do is I mean, if we're going to invest time, money, effort in doing anything, you want to give it as long as you possibly can to pay back. So the flip side of it is, if we're going to invest some money this year, it's better to have BP paying 60% of what we're paying this year, which effectively is what they're doing through the profit sharing. The follow-up question to that is normally, well, why would they do that? They will do that because we will help them push out their decommissioning liability. So, you know, we need to act as quickly as possible. If we don't act, these fields will be all over in the next 8-10 years. So I'm not going to take that risk of leaving it 4 years to try and play a game with BP and then start making the investment if I'm not going to see the return on my investment. So we're going to do what's right for the field. And you know, if that means we share some of the upside with other guys, I'm happy with that. As long as we're making a buck, then I'm quite happy to share that upside.
Clarification regarding the decommissioning costs.
Yeah.
Do they still fall to BP, or are they yours? And if they are yours, are they shown in the share price?
Okay, so the decommissioning costs stay with the sellers. So the deals we've done, BP, Total, BHP, are keeping the decommissioning costs. We will make a deferred contribution, a deferred consideration contribution, equivalent to roughly 30% of their post-tax cost of decommissioning. So in the UK, and I'm not boring people here, in the UK taxation system, effectively HMRC pick up the first 50% of the cost of decommissioning. So we will pay 30% of the remaining 50%. So we will pay 15% of the cost of decommissioning when it happens. We will do the decommissioning, so it will be a lower cost than it would have been if BP or any of the others were doing it. But we will make a contribution towards those costs.
And the final question, if I may quickly.
Yeah.
Normally we talk about tin pot countries having political change and political risks. If by chance there was to be a referendum in Scotland, would that have an impact on the oil fields in the North Sea and your existence? Thank you.
It's a good question, and one that I don't think anyone can properly answer. But we have taken advice. We've taken a lot of legal advice on this, and we do not see that there will be any way that Scottish devolution or Brexit, for that matter, can affect our business. And we don't assess that is likely to happen. You know, we are now a major employer in Scotland. We are now a big part of the Scottish community. You know, we're spending with our partners, you know, in excess of £100 million a year in the northeast of Scotland, and so we're part of that community. And we take our role as part of that community quite seriously, and we don't see any threat from that at this stage.